Hey everyone, Noah Zerby here. This is a series of short videos where we look at some of the foundational concepts in international political economy, or IPE. This video focuses in particular on the balance of trade. Let's go ahead and get started. So let's start with some very basic terminology. Exports are goods or services that are produced in one country and are sold in another. The country selling the goods is the exporter, and the country purchasing the goods is the importer. So imports and exports are basically two sides of the same coin, or the same transaction, that depend on your perspective. One country's exports are another country's imports, and vice versa. We can contextualize this with a specific example. Consider the United States and China. In 2019, the United States exported about $106 billion worth of goods to China. Our major exports included commercial aircraft, agricultural goods, especially soybeans, semiconductors, and automobiles. That same year, the United States imported from China about $452 billion in goods, mostly computers, cell phones, apparel, clothing, footwear, those sorts of things. The difference between exports and imports is referred to as the balance of trade. Put another way, the balance of trade is simply the total value of exports minus the total value of imports. Because of this, balance of trade is sometimes referred to as net exports, or the abbreviation NX. Note that the balance of trade generally excludes trade in services, which the United States is relatively good at, as well as other capital transfers like foreign direct investment. We come back to these items in another video, but for now, just note that these exclusions hide some important information. As a result, balance of trade is a somewhat limited concept, but it's the best one we have, so it's still widely used. In practice, trade is rarely, if ever, perfectly balanced. One country will always export more than they import, or import more than they export with particular single trading partners. If a country runs a positive balance of trade, that is, it exports to another country more than it imports from that country, it runs a balance of trade surplus, or a balance of payments surplus. In 2019, China ran a trade surplus with the United States totaling about $345 billion. That is $452 billion in exports to the United States minus the $106 billion of imports from the United States that year. Conversely, if a country runs a negative balance of trade, that is, if it imports more than it exports, it's said to run a trade deficit. In 2019, the United States ran a trade deficit, or had a negative balance of trade with China, of about $345 billion. Now, most media and popular narratives around balance of trade are based on the assumption that trade deficits are a bad thing. In fact, the vast majority of countries around the world run trade deficits, and it's not necessarily a bad thing. I'll come back to why in just a couple of minutes. It's also important to remember that these figures can sometimes be based on problematic data. Indeed, because of challenges associated with collecting data, total global exports exceed total global imports by about 1% annually. Of course, that's impossible. By definition, global exports must equal global imports. This discrepancy is generally believed to be the result of poor accounting or deliberate attempts to evade recording, either because people are trying to avoid paying taxes or due to smuggling or illegal trade. Now, I previously said that a couple of important items are not usually factored into balance of trade. The first is trade in services. We normally think of exports and imports as tangible things: cars exported from Germany to the United States, soybeans exported from the US to China, or consumer goods from China to the United States. But for many countries, and especially for developed economies, the production of goods represents a relatively small portion of total economic activity. In the United States, about 70% of total economic activity, that is both employment and share of gross domestic product, is actually accounted for by production of services. In the European Union, the figure is about 75%. In other words, the vast majority of our economy is actually centered on the production and consumption of services, not goods. Things like healthcare, financial services, entertainment, and so on represent the vast majority of all economic activity in the developed world. Transportation, communication, and education are also all considered services. And we export these things too. Service exports include financial and banking services, licensing fees paid to companies like Apple or other software vendors, professional advisors, call centers, internet and cloud-based software, and so on. Movies, music, and other forms of entertainment are also considered service exports. So is tourism. When a foreign tourist visits another country, their visit is considered a trade and service or a service export. When you add up all of these kinds of things, they represent a large portion of international trade. For a country like the United States, trade and services represents more than a third of our total exports. But these figures are not generally counted in the balance of trade numbers. If they were, because the United States and many other developed countries have a trade surplus in the area of services, the total U.S. trade deficit would appear to be much smaller than the numbers we normally see. The other item that's not generally considered in the balance of trade figures is capital transfers, including foreign direct investment. Put simply, a capital transfer is the transfer of an asset, for example, a building, or the cancellation of debt. When an international firm sells a building in a country or when it writes off its debt, those are not counted as part of the balance of trade. Foreign direct investment is an investment made by a company based in one country in assets in another country. When Apple builds a new iPhone factory in China, or when Volkswagen builds a new car factory in the United States, that's considered foreign direct investment. According to the United Nations Conference on Trade and Development, the total value of FDI in 2019 was about $1.39 trillion, down from its peak of about $2.03 trillion in 2015. This represents more than 10 times the flow in total foreign aid. Now, the distribution of foreign direct investment is uneven. About half of all FDI goes to countries in the developed world. The United States is actually the world's largest recipient of foreign direct investment, receiving about $251 billion worth of FDI in 2019. China, Singapore, Brazil, the United Kingdom, France, India, Canada, and Germany round out the other top recipients of foreign direct investment. So foreign direct investment is valuable, but is it a good or a bad thing? Like so many things, it depends on where you stand. Proponents of FDI argue that it provides a sustainable source of investment for countries around the world, particularly for those in the global south, who may not be able to access international credit markets to finance developmental projects or economic growth. They also argue that it provides access to technology for developing countries. Certainly, China has been very effective in its use of foreign direct investment to facilitate technological innovation, essentially requiring companies to share technologies in exchange for permission to invest in the country. These forced technology transfers, as they're sometimes called, became a key point of contestation between the United States and China in the past few years, with the United States alleging that such requirements were an unfair trade practice. For its part, China's agreed to reduce its use of them, but neither side appears entirely happy with the agreement. Another benefit of foreign direct investment is that it frequently facilitates economic growth in recipient countries, leading to increased employment, improved living standards, and growth in tax revenues. According to its critics, however, foreign direct investment usually comes with some high costs. Foreign direct investment can present both risks for the investor and for the recipient country. From the investor's perspective, especially when investing in the developing world, rapid political or economic change can represent a threat to the investment. Fluctuation in exchange rates could wipe out potential profits. And in the extreme, revolutionary regime change could expropriate or seize property and eliminate investments altogether. From the recipient country's perspective, foreign direct investment could be withdrawn at a moment's notice, making it a risky basis on which to structure an economy. Similarly, to attract foreign direct investment, countries are frequently forced to compete against one another. They may do this either through tax incentives, for example, promising low or no taxes for some period of time, or through regulatory frameworks, reducing labor and environmental protections, for example. This is often done through the establishment of so-called special economic zones, where broader regulations may not apply. All of this leads some critics of foreign direct investment to describe it as neocolonialism or a form of modern-day colonization. They argue that traditional modes of colonial control in the global south have been replaced by indirect forms of economic exploitation. We look at some of these arguments later in the course when we talk about development. Finally, let's answer the question, how do countries cover trade deficits or surpluses? That is, if the United States runs a trade deficit with China, what does that mean in real terms? Does the United States simply write a check to the Chinese government? First, let's clarify that. No, the trade deficit does not mean that the United States government has to write a check to the Chinese government. Remember that the vast majority of economic transactions that generate the U.S. trade deficit are actually private purchases by U.S. consumers of Chinese manufactured goods. It's not a governmental debt. In a sense, it's no different than purchasing a good produced by an American company. Your money still makes its way to the company that produced the item you're purchasing. It's just that that company is based in another country. It's also important to remember that the international trading systems is far more complex than just trade between two countries. Countries may run trade surpluses with one partner and trade deficits with another. In 2017, the total U.S. trade deficit was about $566 billion. The United States exported a total of about $2.9 trillion worth of goods, while importing about $2.3 trillion worth of goods. We ran trade surpluses with some countries like Brazil, the Netherlands, Belgium, and Australia, and trade deficits with others like China, Mexico, Japan, and Germany. But even with a total trade deficit of almost $500 billion, the U.S. probably shouldn't be excessively worried about it. In part, trade deficits are a natural outgrowth of economic prosperity. The average American family earns about $60,000 per year. The average Mexican family earns about $13,000 per year. Americans have a great deal more disposable income and wealth than Mexican families on average. This doesn't mean that the trade deficit with Mexico leads to American jobs migrating there. That's a fundamental misunderstanding of what's actually going on. Rather, it means that Americans have more money to purchase things regardless of where they're made than the average Mexican family does. As other countries develop, we'd expect to see those trade deficits close. So that concludes our brief introduction to balance of trade and foreign and direct investment. Thanks for watching, everyone. Bye.